Welcome to the fourth analytical episode about such an income-generating tool as farming. I hope yesterday was a successful day for you and you went to bed with a sense of accomplishment, knowing that you did well and made the right decisions in your investment operations. Today we'll take a closer look at the next pool. This is Baby Doge and TON. This is a meme token pool with an alarming annual yield of 656%. Description and purpose of the tokens. Baby Doge. Baby Dogecoin is a popular meme token that appeared in 2021 as the son of Dogecoin. It was originally launched on the BSC, Binance Smart Chain and Ethereum networks, where it attracted a huge community of millions of holders. Over time, the project developed its own ecosystem, including the Baby Doge swap decks, NFT collections, games, and even some AI tools. However, at its core, Baby Doge remains primarily a meme. Its value is driven by a massive fan base, not by fundamental utility. In 2023-2024, the team decided to make Baby Doge multi-chain, and in May 2025 announced the launch of the token on TON. This is telling. TON attracts projects that want to expand their reach. Telegram's audience is about 1 billion users. An attractive audience. Baby Doge on TON is likely a wrapped or newly issued version of the token. Technically, a token with the same name and a certain limited supply has been issued. The Baby Doge and TON pool on STON.fi provides liquidity for trading this token within the TON ecosystem. In fact, it allows the TON community to join in on meme culture. You can buy or sell Baby Doge for TON. For the Baby Doge community, this is also a plus and new market where their token is backed by real TON technology. STON.fi and the TON Foundation supported the listing, expecting that a well-known meme coin would attract new DeFi users to TON. The launch was accompanied by a farming event with a prize pool of $10,000 in Baby Doge tokens for 2 weeks. So, in addition to the trading opportunity itself, liquidity providers received a generous incentive. In summary, Baby Doge and TON are a mix of fun and profit. It gives a major meme project a platform on TON and offers farmers a short-term high APR. The question of long-term viability depends on whether Baby Doge will take root on TON as a full-fledged token or remain a one-off event. The source of this pool's yield. At launch, the APR was 656%, and it was mainly supported by farming. The condition is that $10,000 in Baby Doge tokens have been allocated as rewards for liquidity providers. The period is 14 days without a lockup. You can exit at any time. 10,000 over 2 weeks is 260,000 per year, hypothetically, which is distributed among liquidity providers, the farmers. If the average TVL over these 2 weeks was, say, 40,000, then the effective annual yield is 650%. This matches the estimate. So roughly the TVL was in the tens of thousands of dollars. Rewards were likely accrued daily, and they could be claimed and sold. The commission income from Baby Doge is a well-known volatile meme. The announcement about TON could have attracted speculators. There was trading volume. Perhaps Baby Doge enthusiasts were buying and selling. Dex Screener showed liquidity of $314,000 and a daily volume of 44,000 2 weeks after launch. That's about 14% turnover. That's quite high. With the commission rate on TON.fi being 0.3%, this is approximately 15% per year. That's quite a lot. And this was already after the hype had died down. The APR in the first days could have been even higher due to the large trading volume. Plus, farming 656%. Altogether, in the first days, the APR could have exceeded 700% annual rewards. Unlike the Switch pool, here the rewards were paid out in Baby Doge itself, meaning LPs received more meme tokens, which they could either sell immediately or hold. For many farmers, the right strategy would have been to sell the rewards as they were earned, since meme coins are high risk and can lose value. But some might have chosen to hold, believing in future growth. After June 4, 2025, when the company ended, direct rewards stopped. However, Baby Doge has a huge supply, 420 quadrillion on Ethereum and BSC, and possibly less on TON, but still an astronomical amount. There is no inflation as such, since all tokens have already been issued, so no new distributions from the project are expected, except for a specially reserved pool. Conclusion: 656% is a temporary promo APR due to the $10,000 bonus. The actual sustainable APR afterwards depends on trading activity. The Baby Doge TON pool may maintain a double-digit APR if trading volume remains. Meme coins are sometimes traded actively. At the time of the last review, after farming ended, the APR was decreasing. On Twitter, they mentioned 497% at the end of the period, and a week later 534%. These are fluctuations reflecting the remaining current rewards plus fees. Expect that without rewards, the APR will drop to less than 50% rather quickly, and then further down to the 10 to 30% range or lower within a couple of months as the hype dies down. Technical risks. Baby Doge on TON is most likely a bridge token. It's unclear whether the original Baby Doge tokens were burned and then issued on TON, or if they simply minted new ones. The latter is more likely. Baby Doge has no emission limits, meaning they initially have a huge supply and they can distribute it across different chains. It's possible that the TON version is backed by a reserve on BSC. There is a risk associated with the Baby Doge contract on TON. If it's a GTON, you need to check who the admin is. Most likely it's the Baby Doge team. They could have built in some features. The original Baby Doge on BSC has transaction taxes, burn mechanisms, and similar features. Do these features exist on TON? If so, then each transaction could burn a portion of the token or allocate it to a fund. This affects profitability, commissions, or slippage might be higher. Hopefully this has been disabled on the DEX, otherwise liquidity providers could lose money on every swap if there is a tax. Audit. Meme coins usually don't have audits. The token code is simple, but it can have hidden features like taxes. STON.fi Medium warned to do your own research, meaning they don't provide any guarantees. The DEX smart contracts are functioning as intended. Bridge risks. If the TON version is backed by a bridge, there's a risk that the bridge could fail, and TON Baby Doge would lose its ability to be converted to the original. But perhaps this doesn't matter, since Baby Doge is only valuable within its own community, and they themselves decided to recognize the TON version as legitimate, effectively expanding their tokenomics. If TON Baby Doge suddenly isn't confirmed by the original, it will turn into a fake, the price will drop, but the team themselves announced the integration, so this is the official token. The risks based on the Baby Doge code are original, but Baby Doge BEP20 has built-in centralization, a blacklist, and tax changes that the TON team controls. The TON version may also be managed by the team who, for example, could issue additional tokens, but it's likely they fix the supply at launch and won't change it. Conclusion. Technically, Baby Doge TON carries the typical risks of meme coins. Unexpected actions by the team are possible. For example, they could burn the liquidity though that's unlikely or abandon support for the TON version, or fall victim to an exploit in the original contracts. However, the DEX pool itself operates transparently. No specific technical issues have been identified. Market risks. Volatility. The Baby Doge token is an ultra-volatile asset with its price measured with 10 zeros after the decimal point. Even the slightest fluctuations in absolute terms result in changes of dozens of percent. Historically, meme coins can surge by hundreds of percent within days during hype, and then drop by 90% or more once interest cools off. On TON, there isn't much of a separate price chart yet, but for example, in the 2 weeks after launch, the price increase slightly about 4% likely relative to external markets or the initial price. However, everyone knows that in the long run, coins like this tend to decline unless there is a constant influx of new holders. Liquidity. Baby Doge has enormous overall liquidity on BSC and Ethereum, with a market cap in the hundreds of millions of dollars. But on TON, liquidity is limited just a few $100,000. There is a risk that arbitrageurs will align the price with external markets. If the price on TON suddenly goes higher, they'll bring tokens over from BSC via a bridge, if available, and sell Theme or vice versa. This will help keep the price at parity, but it can also drain liquidity from TON if the conditions aren't right. Project reliability. Baby Doge is not a scam, meaning it's not a money-grabbing scheme. The project has been developing for over 2 years and has a real community. The risk isn't that the team will disappear tomorrow, but that the crowd's interest will fade. Memes survive on attention. If at some point the meme season ends, Baby Doge could slowly deflate in price, just like many other memes did after 2021. On the other hand, Baby Doge is actively trying to be useful. They launched their own DEX and utilities to stay afloat. But objectively, this is an asset with a very high level of market risk. It can lose 50% in a week for no apparent reason. A major holder might sell, or the meme trend could end, or it could just as easily surge just as speculatively on a TikTok viral wave. For a liquidity provider or a farmer, all these scenarios mean a lot of turbulence. Correlation. Baby Doge has practically no correlation with TON. It's a completely separate universe. This means that by holding them as a pair, you are essentially taking on the volatility of two independent assets. One is a volatile technology token, the other is a hyper-volatile meme. This isn't a hedge, but rather a doubling of risk. So, if TON drops and the meme drops at the same time, you lose a lot. Conclusion. The market risk of the Baby Doge TON pool is the highest among those considered, comparable to the risk of the Switch TON pool. The only difference is that Baby Doge is a bit more mature, it has its own army of fans and some resilience as a meme brand. But the question is how many fans will come to TON? In the foreseeable future, after the initial hype, interest may have dropped and the risk of being left holding a low liquidity token increases. Impermanent loss risks. As with Switch, the impermanent risk here is huge if there are strong price movements. If Baby Doge drops by half relative to TON, then the impermanent losses will be about 6%. If it drops tenfold, which can easily happen over a long time frame if the meme collapses, then losses will reach 40% or more. In other words, you will lose almost everything. Not only will the asset drop in value by 90%, but impermanent loss will finish you off as well. If the price moves in the opposite direction and Baby Doge increases tenfold, then the losses will also be around 40%. And although you will make a large profit, it will be 41% less than if you had simply held Baby Doge. Any asynchronous movements between TON and Baby Doge cause IL, and they are almost always out of sync. The only chance to avoid impermanent loss to E is if both pool tokens fall or rise at exactly the same proportional rate at the same time. That's unlikely unless the entire crypto market crashes together, with everyone flocking only to gold and memes. And there's another complicating factor. Baby Doge has a large external market. If there's little liquidity on TON, the price can change abruptly in jumps, leading to instant IL even from arbitrage buyouts. But since the farmers knew what they were getting into, counting on the rewards to outweigh the IL, the reward over 2 weeks is about 50%. If the price of Baby Doge hasn't dropped by more than 50%, they're in profit, or at least not at a loss. In practice, over the 2 weeks, there didn't seem to be any major price movements. The rate was fairly stable compared to the starting point, and may have even increased. This is the ideal scenario for farmers to receive 50% in tokens and almost not lose anything to impermanent loss. But such good fortune rarely lasts long. Long-term IL. If someone continues to hold LP tokens after farming ends, they are almost certain to face impermanent loss, because in the long run, either TON or Baby Doge will change in price many times over. For example, in a year, TON might double in price, while Baby Doge could drop to half its value. In that case, the farmer suffers for both reasons. Conclusion. IL in this pool is extremely high and requires active position management. Only by exiting in time after receiving rewards can you avoid significant IL losses. Otherwise, over time, IL will eat up all the profits from the initial bonuses, especially if Baby Doge goes down. The possibility and conditions for withdrawing profits. A nice feature of farming Baby Doge TON was the absence of a lockup. LP tokens were not locked. The farmer could exit at any time if something went wrong. He could also claim Baby Doge rewards and sell them every day if he wanted to. This provided flexibility. In theory, if the price of Baby Doge suddenly dropped, a smart farmer could immediately remove liquidity, sacrificing the remaining rewards but preserving their capital. Unlike the pool with the switch token, here you could react to the market. Monthly profit withdrawals were possible during the promotion, but it only lasted 14 days. Here it was more like a 2-week withdrawal at the end. After the promotion ended on June 4th, the reward stopped. If someone left their liquidity in after that, now they can only collect fees. As we've already discussed, these are small amounts that can be withdrawn at any time by selling part of the LP tokens. The Baby Doge project did not announce an extension of the farming. Usually they limit themselves to a single promotion. So any further farming is just DEX trading. Profit conversion. Farmers received their profits in the form of Baby Doge tokens. If their goal was TON or stablecoins, they had to sell more Baby Doge than TON, which may have put some downward pressure on the price of Baby Doge. But a volume of $10,000 is not large enough to crash a multi-million-dollar meme. However, the liquidity in the TON pool is small, so a $10,000 sale could have caused a dip on the TON DEX. But this is where arbitrageurs come to the rescue, because seeing a cheaper Baby Doge on TON, someone could buy it and sell it on BSC, thereby leveling out the price. In general, it was possible to withdraw rewards, and most likely many people took advantage of this, which is reflected in the APR. It dropped from 656% to 497% closer to the end, probably due to an increase in TVL or a decrease in the price of rewards. After the main liquidity was withdrawn at the end, many probably exited as well, locking in their results. Some may have left their positions if they believe that Baby Doge on TON will be in demand. Withdrawals are now possible after the campaign. You can continue to hold LP and, for example, sell the fees monthly, but you shouldn't expect much from them. Or if the token rises, you could exit at the right moment, partially locking in profits. But that's already active trading, which goes beyond the scope of passive farming. Summary: the Baby Doge pool was suitable for making quick profits over a couple of weeks, with the flexibility to manage your position. For the purpose of conservative farming and withdrawing profits monthly, it's not particularly suitable, because its appeal lies specifically in the short-term spike in APR. You can't count on steady income. Either you'll have to wait for new promotions or take risks with volatility without the support of rewards. Thus, long-term yield stability is unrealistic, since the current hundreds of percent APR are fleeting. As soon as the $10,000 bonuses are distributed, the APR will collapse. Experience shows that a few days after farming ends, liquidity will decrease and reward hunters will leave. Trading volumes will also decline. The hype is over, and the APR may drop to double digits or even lower. Perhaps the Baby Doge army on TON will maintain some level of activity. For example, if Baby Doge is integrated into the TON ecosystem payments in bots, stickers for Baby Doge, anything like that, then there will be transactions, but for now that's not obvious. Most likely over time the APR will continue to decline. If it started at 500%, in a month it might drop to 50%, and in 3 months to 10%, assuming liquidity remains but there are hardly any trades. On the other hand, memes go through cycles. A sudden pump can happen again. For example, if Baby Doge gets listed on a major exchange, or if Elon Musk tweets about Doge. Then, even on TONDEX, trading volume could spike for a couple of days and the APR would temporarily jump. But it's hard to predict that. Sustainability implies consistently high returns, and that's where the problem lies. The Baby Doge project won't be constantly subsidizing liquidity. The rewards with a total pool of 10,000 are a one-time event. If they like the results, for example, if the TON community grows, they might do it again, but that's not been announced. Usually meme projects don't spend too much on things like this. They're more likely to rely on an organic community, so you shouldn't expect a second wave of 600%. Was this APR real? Yes, people were actually paid 1 to 2% per day in tokens. This was reflected in the UI, but realizing the profit depended on selling those tokens, and the market could drop if everyone sold. In the first few days, however, the price held steady, which means the market absorbed this emission. It's impossible to maintain such an APR for long. 10,000 for 2 weeks is a planned expense. After that, no. If someone kept promising 600% annual returns on a meme coin for a long time, it would mean either new meme coins are being printed, diluting their value, or the team's budgets are being burned. Neither of these can go on forever. Conclusion: the Baby Doge pool is a short-term opportunity, not a long-term income tool. A conservative investor is better off exiting after the promotion ends, unless you're a Baby Doge fan and want to hold it and ton in equal proportions, in which case you can stay for the small commissions. But that's already an investment in a meme, not in income. Now let's take a look at another interesting pair. This is the ECOR and TON token pair, the ECOR Pay token pool with a yield of 496% APR. Description and purpose of the ECOR tokens. ECOR Pay token, a utility token of the ECOR Pay project created on the TON blockchain. According to the description, ECOR Pay aims to become a payment solution within the TON ecosystem. The token is intended for the payment of digital and physical goods and services, providing fast and secure transactions. Unlike meme tokens, ECOR is positioned as having utilitarian value. According to their statement, there is cross-chain compatibility, real use in dApps, and even participation in protocol governance. ECOR holders can influence the project's development. The project emphasizes community and long-term engagement. The tokenomics model incentivizes holding tokens, participating in staking, voting, and building on the platform. In other words, ECOR Pay wants to stand out from ordinary tokens by offering some real utility. However, it is clear that ECOR is a new token. The launch appears to have taken place in the spring of 2025, and it still needs wider adoption. Listing on STON.fi is part of this company. The ECOR TON pool provides liquidity for trading ECOR on the DEX. ECOR is also traded on DDAST, another DEX on TON, where the pair consists of ECOR and USDT. In other words, the team was actively creating markets. On STON.fi, the ECOR TON pool initially had substantial liquidity, around $500,000 in TVL, which kept the price relatively stable. At launch, the APR yield was abnormally high. A Medium post mentioned 935%. Binance Square even reported yields exceeding 1,000% per year. And in a user's review, it was listed as 496%. This indicates that ECOR also launched a farming campaign. Most likely, either ECOR tokens, TON tokens, or both were distributed. There are no details in STON.fi's official sources. Most likely, ECOR Pay allocated its own token to incentivize liquidity, similar to what Baby Doge did. This is indirectly confirmed, since the wording 935% APR plus bonus tokens for liquidity providers sounds like a distribution of ECOR or a partner token. Overall, ECOR TON is an example of a new project on TON that attracts liquidity with high interest rates, but claims to have fundamental value as a payment token for the TON ecosystem. Source of yield. In the first weeks after the launch of ECOR TON, the yield was measured in the hundreds of percent. The source was farming rewards. A possible scenario is that ECOR Pay, together with STON.fi, launched a farm where, for example, a certain amount of ECOR or USDT was allocated. We did not find any public announcements on Medium, but a Medium blogger mentioned bonus tokens. That is most likely ECOR tokens. It's also possible that STON participated and could have added their own tokens to the mix. In any case, the high APR was due to external subsidization. After the first wave, the APR decreased. Apparently, either the TVL increased or part of the rewards was claimed. The figure of 496% suggests that either some farmers left or the rewards were recalculated. And regarding the pool's commission, the ECOR TON pool received significant liquidity, $500,000, but the trading volumes, judging by the data, are modest, about 6,000 per day. That's less than 2% of the total daily turnover, which is very little for such large liquidity. The commission APR there is microscopic, around 2% per year. Obviously, without additional incentives, no one would keep $500,000 there just for a 2% annual return. So incentivization played a decisive role. ECOR is also traded on DDUST with 50,000 in liquidity, and on the TON USDT pool with 512,000 in liquidity, there may have been additional rewards there as well. It's hard to say about DDUST, but most likely STON.fi as the leader attracted the main pool with rewards. Perhaps ECOR Pay distributed the equivalent of 10,000 in rewards on STON.fi and 5,000 on DDUST, but that's just speculation. As expected, the promotion had a limited duration, most likely 2 weeks or 1 month as well. After it ends, the APR will depend on what the fees provide and, if the project decides, some smaller ongoing rewards. Conclusion: the source of the 500% APR was the project's rewards, ECOR tokens. The actual trading yield is minimal, so after the distribution ends, the APR will drop closer to zero unless there are further programs. Technical risks. The ECOR token is a token on TON. The project presents itself as serious. Payments are cross-chain, so we can only hope that the contract is made without loopholes. Nevertheless, young projects have a high risk of admin key centralization. Often, the team retains the right to mint additional tokens or manage wallets with liquidity. It's necessary to check whether all tokens were issued at once and who controls them. If it's the team, then there's a risk of dumping. They could gradually sell the tokens, putting pressure on the price. However, if they want a payment token, stability is important to them. Audit? There's no information, but given their ambitions, it's likely that an audit was conducted or is in progress. The smart contract risk for the DEX is the same, at foreign language V2. CoinPaprika indicated that ECOR is also on Solana, meaning the project is multi-chain, at least on TON and Solana. This means there could be bridges. Bridges are an additional risk, as thefts and desynchronization are possible. For now, ECOR is mainly associated with TON. CoinGecko and Coinbase show the TON pool as the main one. It's possible that the Solana version was an early prototype, and now the main focus is on TON. Possible technical vulnerabilities. Since ECOR is declared as a payment token, meaning it is intended to be used for payments by wallets, bots, and APIs, this goes beyond LP risks but still affects the project. If the infrastructure is not established, the token will remain purely speculative. TON support. ECOR Pay is presented as part of the TON ecosystem and may be collaborating with the TON Foundation, but this is not certain. That would inspire more trust. Conclusion: technically, ECOR is more serious than meme tokens, but it's still a startup. The risk of a scam is low, it doesn't look like a rug pull after farming scheme, and there are investments being made in the project. But there is still a risk of mistakes and shortcomings. Nevertheless, for LPs, the main fears are: if the token contract were to allow, for example, a sudden increase in supply or freezing of accounts, then LPs would suffer. There is no information about this. It is necessary to study the token code or ECOR Pay's documentation. Market risks. Volatility. ECOR, despite its utility status, is still trading like a typical new altcoin. The price is 4.5 cents. Trading volumes are low, which means that potentially any news could move the price. So far, there haven't been any significant movements. For example, over the past week, it's up 6%. But keep in mind, liquidity is high $500,000. So at the moment, the price is stable, but if someone withdraws liquidity after farming, volatility will spike. Liquidity is distributed. There is an ECOR USDT pool, also on foreign language, with 512,000 in liquidity. Apparently, ECOR Pay has also added a stablecoin pool, providing the option to exit directly into dollars. This is good as it reduces dependence on the TON price. There is also an ECOR Major pair. Major is another TON token, but it's smaller. Large liquidity indicates team investment. It's possible they themselves locked in significant funds to ensure smooth trading. This is positive for market risk. There are fewer spikes, but it carries the risk of losses for the team if the price moves against them. However, since they control the issuance, they can also influence the price. Project reliability. ECOR Pay aims to be part of the TON ecosystem. If they have strong developers behind them and they deliver on their promises widespread adoption of payments, the token could hold its value or even increase in price. But that's a big if. There is also competition for payment solutions on TON. There are stablecoins and there is the TON coin itself. It's unclear why a separate token for payments is needed when TON already exists. Maybe it's for discounts, cashback, or pegging to fiat value. So far, such details are not publicly available. The ECOR Pay website describes its goals in rather general terms. The risk of a significant drop is present, as with any newcomer. If the initial investors or the team decide to take profits, the price will crash. The FTV is 457 million, while the circulating cap is unknown. In other words, any unlocking of new coins could drive the price down. The distribution principles have not been found, but if it's standard, X% to the team, Y% for marketing, then there could be unlocks in 3 to 6 months, so caution is needed. There is a risk of low demand. A payment token is valuable when it is actually used. So far, this hasn't been proven. Demand comes only from speculators and farmers. When the rewards run out, many people may sell ECOR, especially those who farmed for tokens. If there are few real users, the price will drop. Liquidity withdrawal risk. As soon as the bonuses end, a portion of the TVL will likely leave and farmers will withdraw liquidity. This could lead to greater price volatility. Ironically, the remaining LPs might then earn more in fees, but they also face greater risks. Competition. If TON launches its own official payment solutions, like TON Payments, or if major companies such as Telegram introduce their own token, ECOR could be left on the sidelines. This is a strategic risk for its value. Conclusion. The market risk of the ECOR TON pool, while not as extreme as that of meme coins, is still high. A new token means an uncertain future, even though good intentions have been declared. Volatility may be somewhat lower while the team supports the market, but it's difficult to predict the trajectory. Impermanent loss risks for ECOR TON are comparable to those of other pairs. This pair can be called a volatile token pair, like many others. Both ECOR and TON are volatile. If TON and ECOR move in sync, impermanent loss is minimal, but more likely ECOR will move independently. So, if TON increases by 50% over the year and ECOR loses 50%, then the liquidity provider will lose about 15% overall. This is relative to simply holding both halves. If ECR shoots up by 300% while TON's price doesn't change at all, then the losses will be around 25%. In other words, you won't get 300% profit on half of your portfolio, but less. So far, while liquidity is high, there haven't been any major imbalances. But if liquidity drops and ECR starts to swing wildly in a thin market, IL risks increase. Farmers' mitigation. Again, farmers were hoping to offset IL with rewards. 935% APR, meaning that even if the price drops by 50%, IL losses would only be about 5 to 7%, and you'd still be well in the black thanks to the rewards. But after the promotional period ends, that's no longer the case. Long-term risks. Impermanent risks depend on the difference in performance between TON and ECR. If you believe that ECR will follow the same trend as TON, for example, if both rise along with the overall market, then IL may be minimal. But if ECR goes its own way, for instance, stagnates while TON grows or vice versa, then IL will eat into the profits from the asset that's rising and increase your share of the one that's falling. The worst case scenario is a one-sided market. TON goes up, ECR goes down. In that case, the liquidity provider will end up with more of the depreciated ECR, or TON goes down and ECR goes down as well. Both assets are falling. Impermanent loss might soften the blow little, but both have lost value. So this approach, like a 50-50 portfolio, doesn't offer much protection. Conclusion: IL is significant, but not catastrophic, as long as the tokens don't make extreme moves like plus 10 times or minus 10 times. Nevertheless, for a conservative strategy, this is a risk, since ECR is still not highly correlated with anything, and it's difficult to predict its movement. The possibility and conditions for withdrawing profits. If ECR farming was similar to Baby Doge, then there was no lockup period. In any case, it is not mentioned anywhere. Most likely, LP tokens could freely enter and exit. Perhaps that's why the APR was initially huge. There were few participants at first, then it quickly dropped when many people added liquidity to chase rewards. A dynamic process. The rewards were most likely paid out in ECR if it was their own project or in STON. If the rewards were in ECR, then, just like with Baby Doge, farmers could sell them immediately, which created selling pressure on the price, though not very strong as long as the volumes were small. The option to withdraw earnings monthly. During the promo period, you could withdraw as often as every minute, but in that case, you would stop farming. Usually, people hold until the end of the period to get the maximum rewards and then exit. In this case, judging by the decrease in APR, one can assume that either the period has ended or the TVL has increased. It's possible that the promotion was short on or 2 weeks. Now, about a month after launch, the APR is 30 to 50%, which means it has predictably dropped. So, most likely, the active rewards have ended. If the investor has stayed in the pool, they can now either reallocate their funds or continue to hold, relying on the long-term growth of ECR and some future utilities. Withdrawing profits now basically means taking whatever small amount of fees has accumulated, and if they manage to sell some ECR during the hype, of course, farmers with rewards could claim and sell them constantly, which they probably did. In the future, if ECR suddenly resumes farming, it will be possible to withdraw rewards regularly. If not, then as usual, accumulate the fees and withdraw them. Technically, STON.fi allows you to claim rewards through the farming interface. There are no withdrawal restrictions if there was no lockup. If there had been a lockup, like with Switch, we would have seen the APR stay high all the time. No one could enter or exit easily. Here, there was a decline, which means there were no restrictions. Conclusion: the ECR TON pool allowed for flexible farming participation, and it was possible to partially withdraw earnings. But it is not suitable for a conservative monthly farm, since the main profit comes from a short-term promotion, and after that you either hold in hope or exit. Long-term yield sustainability. The current 496% APR is probably no longer relevant. It was at the time of the last review. Now the APR has normalized. In the long term, if the project is successful, ECR TON may see some movement, but the 900% spike was a promotional push for the launch. After that, without ongoing incentives, the yield will drop to levels that do not attract neutral farmers. Most likely, the TVL will decrease. Those who wanted to earn have done so and left, and those who remain will either be project supporters or the project itself will provide liquidity. In that case, the APR will be determined mainly by trading activity. If ECR Pay really becomes a popular payment system and the core token can achieve high turnover, then the fees could provide a nice double-digit yield. But this is far from a near-term prospect. For now, ECR is barely used. A daily turnover of 6,000 with a TVL of 500,000 is negligible. It's possible the team will continue to incentivize liquidity. For example, they might distribute some tokens monthly to liquidity providers, just in smaller amounts. Some projects run liquidity mining on an ongoing basis, but gradually reduce the rewards. If Corp also decides that liquidity is very important for price stability, they might keep some APR, say 20 or 30% per year in ECR for a long time. This would support the pool, but for now, there is no definite information about such plans from the team. A realistic scenario, you shouldn't count on consistently high yields. The current APR is a newcomer effect. How long did it last? Apparently, the peak at 900% was brief, just a few days, then 600% for another week, and then less than 500%. So the overall period of such yields was within 1 month. Long-term farming from this angle is not an option for ECOR. This is more of a launch event. If the project wanted to constantly issue tokens, it would lead to inflation and price pressure, which they would likely want to avoid so as not to undermine their idea of a valuable payment token. Conclusion. The prospects of the ECOR TON pool as a conservative income-generating asset are unclear. So far, it was a temporary super APR just to attract attention. From here, either the project succeeds and the token grows, in which case LP profits will come from price appreciation, or it doesn't succeed and the token stagnates or falls, causing LP tokens to flow out. Neither scenario provides stable income. With that, we conclude our fourth analytical review of farming tools and projects offering attractive yields. And since the response from the crypto community to our reviews has been very low, we have decided to discontinue this analytical format covering liquidity pools of new projects and farming yields on them. We would like to receive feedback and suggestions for topics for our broadcasts. News from the crypto world is not in short supply on the internet, so this format is also being put on pause. Right now, our team is working on developing an entirely new product on the blockchain. Even just formulating its fundamental principles and creating the foundations for the system's operation requires significant effort and time. Once the basics are established, we will let you know about it. And thank you very much for your attention and time. We believe that our work will help many people become more knowledgeable about profitability in the crypto sphere, and step by step, will make the algorithms for working with blockchain tools and their derivatives clearer and more transparent. Our advice to you is to never rush and to thoroughly analyze and study every opportunity to make a profit. As the saying goes, those who understand life are never in a hurry. And support your parents financially or give them something they've long wanted to have. That's the least you can do for them. Wishing health to you and your loved ones. See you soon!